Ways to reduce your costs in retirement. That's probably one of the hardest things to do, right? You get to retirement and then you realize, ooh, wait a minute, gotta kind of cut some costs here. Maybe something unexpected happens or what have you. How do you do that? So on the program today, we're going to give you 5 ways in which to sort of look at reducing costs in retirement. Plus, we're going to ask the question of how to avoid living on $18,516 per year in retirement. $18,516 per year. Where's that number coming from? Well, that represents the average Social Security check that the average American gets. So what that means is that if you want to avoid living on $18,516 a year, you probably need to start doing something besides just banking on Social Security. Or maybe you're not even banking on Social Security. If you're younger, you may want to perhaps think that through a little bit more. So we're going to tell you how to avoid that, things that you can do now that you can change that situation in retirement. So that's what we'll talk about here on the program. Welcome, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on Sunday mornings on the News Radio WFLA Orlando network, along with 96.9 The Game. Our program also happens to be one of the top 25 financial planning podcasts on the World Wide Web. So be sure and subscribe to us on any of your favorite social media channels. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful and cost-effective financial plan that produces superior results and provides you with peace of mind for the future. So before we get to how to avoid just living on Social Security in retirement and ways in which you can reduce your expenses in retirement, I want to come back to a segment, our last segment on last week's program, where we kind of ran out of time. And so we wanted to kind of dedicate this opening segment to just sort of fleshing out the last couple of things that we were talking about in that last segment, because we kind of had to go quick, kind of had to rush, and it was important, or at least we thought it was important. So we wanted to spend some time just kind of recapping that. And so what we were talking about in the last segment of last week's program was some of the things that you need to be asking when it comes to hiring a financial advisor. We had spent some time talking about the first 3 or 4 items, and just to recap that particular segment in last week's program. So one of the biggest things that we said is sort of number one, right? If you're choosing to work with a financial advisor, one of the first things that you should be asking is, are they a fiduciary? I think that goes without saying in today's world, but sometimes people don't ask that. And so you want to make sure that they are. And one of the ways you can do that is ask for the credentials that they have. Specifically, for example, everybody on our team at Nelson Financial Planning is a certified financial fiduciary. That is the highest sort of standard that you can have, or credential that you can have, that's purely focused on that fiduciary obligation. For those of you who are not sure what a fiduciary is, what it means is that that person that is helping you is acting solely in your best interest. They have a legal obligation to make sure that they are doing that, and that way avoid things like conflict of interest and those types of items that may derive or drive more of the decision-making process than purely what's in your best interest. Number 2 on the list, just to recap, is don't hire the first one you talk to. We actively encourage people to go and talk to at least 3 different people in the industry, and ultimately be able to get a feel for the different types out there. At the end of the day, one of the things that you're going to have to do when you hire a financial advisor is you're going to have a gut comfort level, right? I mean, you've got to be able to relate to this person. This person has to relate to you. That's why we encourage you to go and talk to at least 3 when you are interviewing for a financial advisor. Next on that list was don't pick one that has sort of the wrong specialty. Make sure they've got their expertise is in what you are looking for. Many advisors out there will focus on 401ks or deferred comps, those kinds of things. That's a different type of specialty than, say, for example, retirement planning or retirement income planning. Another thing that you want to be aware of beyond just that specialty is make sure they're actually there to help you. A lot of places will have account minimums that require you to have at least $500,000. Well, maybe you're just starting out and you only got 50,000 or 100,000. You'd like to grow it to 500,000. Make sure that the person that you're talking to is interested in that, and it's not someone that we only want to see you when you got 500. Come back when the hard work is all done, right? Because let's face it, the hard work in life is accumulating assets. Once you accumulate them, the management of them is probably a little bit easier, right, than the process of accumulating. So make sure that they have the specialty, if you will, that you're looking for when it comes to what it is that you're seeking their advice and counsel for. Then make sure you talk to them. This was number 4 on the list. I think this is where we kind of ran out of time, so we're going to spend a little bit of time here on these next few. Don't pick someone that's got a different investment approach. Every financial advisor should be able to coherently explain to you what their investment approach is, why they do it, what they do, and how it's done. Ours, for example, is we use actively managed funds that focus predominantly on large companies that make the stuff that you and I and the rest of the world uses every day. That's our heart of our investment approach. So we're not big annuity fans. We're not big bond fans. Those are the kinds of things that you need to be asking when you're interviewing somebody, is to see what their investment approach is, and more importantly, why. I mean, at the end of the day, one of the reasons why we don't use bonds is, or we don't use that much bonds. Of course, a balanced portfolio is going to have some level of bonds in there, but we're not so stringent as, oh my goodness, you're 70 years of age. Well, then that means you need to be 50, 60% on the bond side. We look really more at that overall picture rather than just kind of having some program where, okay, we're going to be very formulatic on it. So at the end of the day, the priority is more on the stock side, more on the large company side of things. Next up on that list is the notion of being credentialed, right? Check the credentials. What do they have? How long they've been doing this? What's their background? If they're not securities licensed, you need to know that. There's a lot of folks that just specialize on the insurance side, on the annuity side, that they don't have a securities license, so they couldn't sell you or recommend a investment that they're not actually licensed to actually offer. So understand that you need to check their credentials. And then lastly, make sure you ask how they get paid. This should be pretty easy to figure out, but at the end of the day, it should also come with a pretty good description on exactly how they get paid. How is the fee collected? Are there any other costs? And what the returns are net of those expenses. So those are the 6 things to be thinking about when you hire a financial advisor. We'll continue the conversation on the program after these messages. So maybe your retirement plans got accelerated, right? Because of COVID, or maybe a layoff, or maybe you're just looking to improve your cash flow now that you're in retirement. Maybe some of the numbers didn't quite work out as you might have originally thought. We've got 5 ways on the program this morning to reduce your costs in retirement if you're dealing with an unexpected turn of events that's sort of thrown the numbers off a little bit. So welcome back to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you here on Sunday mornings on News Radio WFLA Orlando along with 96.9 The Game. Also, our program happens to be one of the top 25 financial planning podcasts on the World Wide Web. So be sure and check us out there. Just look for us on any of your favorite social media channels under Nelson Financial Planning or Dollars and Cents with Joel Garris. I am, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior results and provides you with peace of mind for the future. So, what are those 5 major ways in which you can reduce those costs in retirement? We're going to look at a wide range of options here. So, let's sort of begin the conversation. First and foremost, and you certainly heard us talk about this on the show before, is you need to analyze your spending. Anytime you're trying to save money for retirement, or you're trying to reduce costs, or you're trying to reduce costs in retirement, it starts with actually getting a handle on how it is that you're spending money and what you're spending money on. So it starts, of course, with sort of writing it all down. Now, that may be a little old-fashioned. In today's world, there's these things called apps, which you can use, that also successfully track that down pretty good. One of the more popular apps out there is the Mint app that allows you to really kind of keep track of all of your expenses that you are doing along the way. If you keep track of the expenses, guess what that means? You're doing the B thing. The B thing as in the budget thing. So one of the ways in which that you can reduce your costs is, first of all, getting an understanding of what it is that they are, tracking the expenses, creating a budget. Bottom line, if you're keeping track of the expenses on a regular basis, then that's going to help you see where money is getting spent. And then when you see where money is getting spent, that's going to give you some guidance or some insight into what you can do to reduce those expenses. Number 2, one of the biggest expenses that people have is their housing costs, right? So perhaps you look at the house that you're in and think about, is there a housing adjustment that you could do? Maybe that's downsizing. Doesn't just simply mean that you're, eliminating rooms. In a lot of cases, most people aren't using some of the rooms that are in their house. So if you're downsizing, then ultimately you go to eliminate the rooms that you're not doing. And also, at the end of the day, beyond just eliminating rooms, or it also helps to reduce down the costs of home maintenance, right? If it's a smaller home, you're going to pay less for power, you're going to pay less for water, sewer, all of that gets less with a smaller house. And more importantly, if you sell the house you've been in for a while, hopefully you've been sort of regularly paying the mortgage, and the mortgage is either non-existent or at the end of the day down to a low amount. Particularly if you still have a mortgage on the property, if you sell and take that cash, you may be able to find, if you downsize, that you're able to take that equity and buy the next house for cash. That obviously would be a game-changing way in which you could reduce your costs in retirement, right? Because you would have effectively eliminated your mortgage that you did not eliminate prior to entering retirement. So consider housing and sort of what's going on with the house and whether a downsize may in fact be worth doing to reduce down those retirement costs. The next one that we've got on the list is a little tricky because it can be cumbersome. This notion of reducing down cars from 2 to 1. The other big expense that you typically have on a regular basis is your car, right? You got to put gas in it, you got to pay insurance, you got to maintain it. And the reality is that if you reduce from 2 to 1, that would certainly serve a lot to reduce your expenses. Now that may be tricky. I mean, logistically, if you think about it, wait a minute, there's still 2 people in the house. That can start to be a little tricky logistically. So maybe what you do is you think about maybe just changing that second vehicle to be one that might be more practical. Maybe that's a smaller vehicle, maybe that's a more efficient vehicle, maybe that's a used vehicle. At the end of the day, think about that insurance cost, the maintenance, the loan, the depreciation, all of that stuff that goes that happens with a car. I mean, a car is not going to appreciate in value over time. The value of a car is going to go down. The value of a brand new car obviously is higher than a car that is 10 years old. So if you're good at sort of coordinating with your partner, that's fine. Go from 2 car down to 1. If that can sometimes be a struggle, then perhaps you look at adjusting what that second car is, what it looks like. Maybe that's a used car, maybe that's a smaller car, maybe that's a more efficient car. So certainly something to think about there in terms of how do we reduce down the costs in retirement. The fourth one is one that we all love as living here in Florida, because we sort of already checked the box on this one. And that means that if you're retired and you're looking for a way to reduce costs, maybe you look for a state that is a bit more retiree friendly. And certainly Florida fits the bill. Of course, every state has its own rules and laws, particularly for retirees. I was actually chatting with my sister who lives out in the state of Washington, talking to her a little bit about some things. And there was a family friend that was running into an estate tax issue. And I said, but how can they be running into an estate tax issue? It's like $11 million per person. And she's like, oh, no. The state of Washington doesn't follow that. They've got an estate tax exemption that is $2 million. So if you're above $2 million, then you have to pay estate taxes. So be aware, every state is different, not just on the income tax side of things, not just on the real estate tax side of things, not just on the sales tax side of things, but it can be things like estate tax that really differentiate one state for the other. Of course, as we said, here in Florida, #1 ranked state for retirees. Why? Well, no state income tax, and despite the run-up in housing prices, our housing here still relatively cost effective, and so too is the standard of living. So certainly looking for a retiree friendly state. Most of us here that are listening to the program here in Florida can certainly already check that box, if you will, because we're living here already. To our friends up north who listen to the program remotely, well, we look forward to having you move down here, because a lot of your neighbors and friends certainly are taking this one quite serious. So next on the list would be insurance, right? This is number 5 on the list of things to kind of look at if you're looking to reduce costs in retirement. And be sure to comparison shop on this one. I think that's really the message there. And when we talk about insurance, we're talking about obviously health insurance, but also car insurance and homeowners insurance. What happens there is that most of us will stay with the same insurer for years and years and years, and then along the way you'll see that cost kind of go up. It's one of those things where I think they give you a rate that looks good, or sort of a teaser type of rate, and then gradually it floats up along the way. And the problem with that is then that means you're paying more money for your insurance than perhaps what you need to do. That's why it's important to comparison shop, call for quotes, get those from different companies. And then of course, certainly on your health insurance side of things, I don't need to tell you guys, hey, there's a wide range of plans out there and a wide range of costs. So make sure that you're looking at that as well. If you are not Medicare age, maybe you're looking at a high deductible plan with a health savings account. That's often a great option. But bottom line on all of that, if you're looking to reduce costs, try and look for ways to comparison shop on insurance. So remember those 5 things if you're looking to kind of reduce costs in retirement. I think a lot of those you could probably do if you're still working as well. So make sure you're analyzing your spending. Make sure you are looking at your housing costs and make adjustments there. Same thing on automobiles. Look to a tax-friendly state like Florida, and make sure you're shopping your insurance. With that, we'll take a break and return here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, the program. So could you live on $18,516 a year? Where do we get that number from? Sadly, many people actually do live on that amount every year. 1 in 4 Americans, it's estimated, live on that amount, because what that amount represents is the average Social Security check that people get. So we're going to talk in this segment about ways that you can kind of think about how to improve that number along the way. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on 96.9 The Game, along with News Radio WFLA Orlando. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with over 13,000 or 14,000 downloads. Anyway, a lot of downloads out there, and we certainly appreciate our podcast listeners. If you'd like to subscribe to any of our podcast channels, whether that be YouTube, Spotify, iTunes, Facebook, whatever the case may be, the reality is that you can certainly do that. You can find us at Nelson Financial Planning or Dollars and Cents with Joel Garris, or if you really want to make it easy, just go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and you'll get directly connected. So my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So speaking of peace of mind for the future, $18,516 a year, that's pretty light income. That translates to $1,543 per month. That's the average amount that people get when they receive Social Security. Approximately 1 in 4 Americans live on just Social Security. The reality is, of course, that Social Security was never intended to be the sole source of income in retirement. Originally, Social Security set up to replace about 40% of income. So stop and think about that, okay? Because Social Security, even in its original incarnation, was set up to generate out about 40% of one's retirement income. That means that there's another 60%, the majority, that is the responsibility of the individuals. Take that one step further. Originally, Social Security was described as one leg of a three-legged stool, with the other two legs being a pension from working and savings. Of course, the problem now is, much like everything, that it has changed in that one of those legs, if you will, the pension side, is not really available as an option to many Americans. So it's really incumbent to beef up that other leg, the savings. And now, of course, you can save on a retirement basis. A lot of retirement savings options, 401ks, IRAs, things like that, were in fact not really around when Social Security was started. So how do you avoid relying on Social Security? Well, obviously starting early is key, right? The sooner you start saving for retirement, the better off you're going to be. As we were talking about in that previous segment, simply keeping track of your expenses is a great way to start the process of spending less than what you make and saving the difference. And so that's a great way to sort of put money towards retirement so that you're not living solely on Social Security. Good rule of thumb, 10%, 15% of income, obviously preferably 15%, and most importantly, automate those contributions. I think far too often people automate contributions like on a retirement side because, okay, great, that's out of my paycheck and my employer does it, so it goes automatically into my 401k, my 403b, my 457, whatever the case may be. But the problem is that a lot of people don't have those available through their employer, so that means that they've got to seek out an IRA or a Roth. But understand that when you do that, you can in fact automate your contributions into that, just like you would if you were working for an employer and that employer had a retirement plan. So the importance of automating those contributions is pretty crucial, because then that way you don't have to think about it. It's not going to slip your mind, and ultimately you know that each and every month it is getting done. Beyond that, you can even set up automatic contributions into like a regular investment account. This type of an account would be sort of an after-tax account. And we think that's always a good idea to have that piece as well, because if you just have retirement assets, 401ks, IRAs, things like that, the reality is that there's some tax implications on that. There's some tax restrictions in terms of what age you can use that money at, and there's also, of course, income tax considerations as well. However, if you've got after-tax money and you're saving that as well, that has none of those restrictions, freely available and free to use, and at the end of the day, taxed at a much less level, because that is predominantly capital gains, dividends, things like that, that are in fact taxed at a lower rate. So in terms of trying to ultimately avoid this notion of living on just $18,516, it really comes down to, you can no longer rely on one of the legs of the three-legged stool, if you will, because pensions are not really a part of society anymore. So that means you've really got to boost up retirement savings. Start early, make sure you're putting in 10-15% of your pay, and most importantly, certainly automate those contributions on a regular basis. If you want to try and sort of supercharge things, obviously earlier in the program we talked about ways to cut costs. At the end of the day, the notion of trying to work longer also comes into play. That's also one of the scenarios where we might suggest to somebody, hey, particularly when it comes to Social Security, if you work longer, you're going to wind up getting a larger amount of Social Security, and that may help to offset if you haven't saved enough beyond that for retirement. So understand that if you wait to your full retirement age, you get your full retirement Social Security, but then beyond that, up to age 70, your Social Security benefit increases by 8% per year. So if you're short on retirement, you're short on savings, you may want to delay taking Social Security, continue to work, let that also grow, continue to increase. Understand also that your Social Security check itself could rise by virtue of you continuing to work as well, because Social Security looks at the average of 35 years of work history. So maybe you're dropping some of those early years off in life that were low amounts of income. Bottom line, start now if you want to avoid living on $18,516 per year, because we don't want you living on just Social Security in retirement. So we're going to shift some gears and I'll let you know about some fun stuff that's happening at the office during the course of December. So this is certainly something that we communicated with our clients this past week, but also wanted to afford an opportunity for the Central Florida community to participate as well. So at our office during the course of the month of December, so starting on December 1, we're going to be doing a couple of different things to help the sort of greater community at large. We're going to be doing a food drive to benefit Second Harvest Food Bank and a toy drive to benefit Toys for Tots. We're very excited about that, trying to kind of do something a little bit festive, a little bit for the good of the greater community, particularly during the course of this year. A lot of people have faced a lot of disappointment and a lot of health issues. I've yet to meet anybody who hasn't had at least something that they were looking forward to get canceled. And with that in mind, we put our heads together at the office and came up with the idea of, okay, well, let's try and do something fun that people will enjoy, that also serves the greater good of the community. So starting on December 1, you're welcome to drop by any non-perishable, unopened food items to support Second Harvest Food Bank. That piece of it actually runs from December 1st through December 16th. And then if you are more, like toy oriented and want to bring by a new unopened toy, you can certainly do that. The toy drive for Toys for Tots actually runs from December 1 to December 10th. So the toy drive got to kind of cut the line or end that one a little bit earlier. The food drive goes to the 16th. So if you're interested in participating, looking for a place where you can drop off some food items for Second Harvest Food Bank, or toys to benefit Toys for Tots, that is happening at the office. So the address 423 Country Club Drive in Winter Park. So if you're interested in participating in those events and looking for a drop-off location, we have drop-off locations for both the toys and the food bank. We'll certainly be mentioning this along the way on future shows as we go through the rest of November here and into December, but wanted to at least get the word out to our radio community. We're going to take a break, and when we return, we're going to continue with some good news to share with you about what's gone on with folks and their COVID distributions out of their retirement accounts. Coming up next on Dollars and Cents. Welcome back to the program, ladies and gentlemen. We've got some good news to share with you about folks avoiding hitting their retirement accounts during the course of this pandemic. Welcome back to Dollars and Cents. We're Central Florida's longest running radio program where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful and cost-effective financial plan that provides you with peace of mind for the future. So what's the good news we're talking about? Well, with the CARES Act provided people a significant option to sort of raid their retirement account. And in fact, you could take up to $100,000 out and avoid the early distribution penalty, pay taxes over 3 years, or in fact, pay the money back over 3 years. Those are some pretty tempting terms, if you will. Wait a minute, I can take money out and I don't have to pay that back, and I can spread out the taxes over a 10-year period of time, and I don't have to worry about a penalty for early withdrawal or anything like that. That's fantastic. The reality is that it's pretty tempting under those terms to raid your retirement account, but the good news here is that less than 5% of eligible participants have done that. That's really, really great news, because at the end of the day, you are raiding your retirement account. So because that percentage was much less than what was expected when originally passed, that's more people that aren't having to undermine their retirement to sort of get through this COVID pandemic. Because at the end of the day, even though the folks in Congress passed this ability to take money out of your retirement and not have to worry about a penalty, if you will, if you're under age 59 and a half, the reality is that you're still raiding your retirement. And when you do that, that means that money is not invested. It's not invested to continue to grow on a regular basis. So one issue that I sort of have with all of this is that Congress is increasingly sort of giving out this notion that a retirement account does double duty as an emergency fund. Since Hurricane Katrina in 2005, Congress has, on a pretty consistent basis, allowed unrestricted access to retirement accounts without any penalty, sort of waiving the penalty in numerous cases over the course of the past 15 years. And the problem with that is it sort of creates the wrong impression of what in fact a retirement account is, right? I mean, first and foremost, retirement savings aren't emergency savings. So those are two completely different concepts. Your retirement savings is money that you should be putting away for the future. Your emergency savings is money that should be available now to cover emergencies. See the difference? Pretty significant. But the folks in Congress, as a result of sort of going down this policy path of saying, oh, well, because this happened, we're going to waive the penalty and let you pay the taxes over an extended period of time, it almost creates the impression, which is the wrong impression for the public to have, that you can treat your retirement account doing double duty as an emergency savings. Look, retirement savings, emergency savings, two totally different things, and you really got to be thinking about them differently as well. And so what the folks in Congress probably really should be doing is helping to educate people on the difference between the two. If you've got savings, emergency savings, that's generally going to be cash that's sitting in a checking account, savings account, money market, whatever the case may be. That's money that's immediately accessible no matter what. Retirement savings, put away for a longer period of time, Well, that means it's going to be invested. Well, if you're opening up the door, if you will, to take money out of retirement accounts during tough periods of time, well, what do you think is going to be happening in the retirement account if it's invested? If it's invested, chances are that that investment is going to be feeling the fluctuations of what's happening in the economy or the headlines, so it's going to be down in value, right? And so when you take money out of the retirement account, then you're ultimately going to be taking out more money than what you would otherwise do, right? If the market's down 20% or 25% as a result of whatever it is that's happening and you need money and you're going to your retirement account, well, then you're having to take out like 30% more in that situation than what you would otherwise have to do. Because when you raid a retirement account, you are selling shares of whatever it is, whether shares of stock, shares of a fund, shares of an ETF, whatever the case may be, you're selling shares. If the value of those shares is down, then you have to sell more shares. So this notion that Congress is putting forth really is just kind of this false notion of treating retirement as an emergency savings account. So be very, very careful with that. It's really great news that a very small percentage of the people have taken advantage of this sort of this COVID exception that the folks in Congress created, because at the end of the day, that has a significant impact on your retirement. It's estimated that these types of withdrawals that occur, the hardship withdrawals, the withdrawals like this COVID stuff, has a tremendous potential over the course of time, because you take that money out, you take it when it's low, you're selling more stuff to get the same amount of dollars. It's estimated that reduces retirement savings that you would have when you get to retirement by as much as 25%. Folks, that's a big number to be thinking about. And again, all it takes is a little bit that can lead now to a tremendous amount of damage in the future. So just be aware of that. Really reject this notion of retirement savings and emergency savings as double duty. So we're going to wrap it on up and get on out of here. Thanks for listening to this week's program here on Dollars and Cents.